Goldman Sachs chief economist Jan Hatzius joins us here at Post 9. Are you still at 4 cuts? Because now that's more than the market and the Fed expects.
We are still at 4, and I would say that at the margin, the news flow, I think, has said they're probably not too far from cuts. Yes, a little bit hard to know how much weight to put on Chair Powell's comment in the testimony, but it pushed in a slightly dovish direction. And if I look at today's jobs numbers, they certainly say that the labor market's very solid and payroll growth is still strong, but there has been a little bit more slack. The household survey and the unemployment rate are a bit softer, and the wage numbers also retrace that big increase that we saw in January. All of that, to me, says we're still on track for a soft landing with some gradual rate cuts as we go through the year.
We're going to get CPI next week, and then we have a Fed meeting, which nobody expects them to do anything for the March meeting. But I wonder how you expect the data to shake out from here on employment and inflation, because it feels like they don't really know, and they're waiting to see that too.
Well, we never know what the data is going to bring, obviously, but I think the inflation numbers will show much softer sequential numbers in the next couple of months than January. To us, January is really a huge outlier to the high side, driven by what we've termed a January effect, which is basically big price increases at the start of the year that are hard to seasonally adjust in a post-pandemic environment. And then this big increase in owner's equivalent rent, which to me looks like an outlier. So with that, I think the next couple of reports are going to look a lot better.
I loved your report a few weeks ago entitled, OE, Are You Serious?, in which you looked at the effect of housing. Do we think that's finally going to creep into some of the macro numbers, at least the kinds of things like new rents, which Powell talked about this week?
Yeah, so kudos to Spencer Hill, who came up with that title. But that was very, I like that a lot, too. Look, I think that the rent numbers are generally showing deceleration and point to a lot of deceleration in the CPI version of that. If I look at the private sector rent numbers, that's true for multifamily, but it's actually also true for single-family rents. So it can't really explain this big jump. To me, it's more likely that we basically just drew a very high sort of sampling observation. It's a small sample, and sometimes these things can happen. If that's right, and we'll find out over the next couple of reports, if that's right, though, then we'll see deceleration from here.
But is the services part of the economy cooling off enough that the Fed would feel comfortable cutting?
Well, I think the question is what happens with where's inflation going? There are two paths to get to cuts. One is a significant deterioration in the labor market. In that case, you get aggressive cuts. That's not what we're seeing. But then the other path, which Chair Powell has talked about many times, is if inflation goes back to 2% and is on its way back to 2%, then there's no longer a good reason to have a 5 handle on the funds rate. And I think that's the path we're on. We're not there yet, but that is what we're expecting over the next few meetings. Our baseline is June. I think May, you can't rule out May. May is a possibility. Obviously, they're not cutting in March.